Hello everyone and welcome again to Saxo's Macro Insights channel. I'm Charu, a market strategist with Saxo Singapore, and this video covers the all-important Fed meeting that was held last night in the US on February 1st, 2023. So let's dig right in. We went into Wednesday's meeting with some bit of hawkish expectations from Chair Powell, if not on the policy move, most certainly on the policy outlook. And while inflation is cooling, the main reason for those hawkish expectations was really the easier financial conditions that we've been seeing over the last few weeks, as you can see in this chart here on the left. That was spooking some concerns on how it can feed back into inflation, perhaps later this year, along with the China reopening and the fresh surge in commodity prices that we are seeing this year as well. But there was not enough pushback on that from the Fed, and the market has taken that positively with risk assets flying. But if you look closely, there are enough hawkish elements in the policy statement. For instance, there were comments like, we need substantial more evidence to be confident about inflation returning to 2%. And they also said that they will have more work to do. So that was reflecting that the Fed is not yet taking comfort from that slight easing that we are currently seeing in inflationary pressures. But Powell's press conference had some dovish hints, and we can't deny that. Specifically, his comment that disinflationary pressures have started. And also, when asked on the easing financial conditions, the pushback from Powell wasn't really strong enough. Overall, the meeting outcome was really non-committal in any direction. And that's enough reason for the markets to stay with its own assumptions. As you can see on this chart on the right, the market implied policy rate for the Fed was already below what the dot plot indicated in December going into this week's meeting. But now that has pushed further lower today. So the market continues to price in about 50 basis points of rate cuts for this year. And the gap to Fed's intentions is certainly increasing. Overall, the market does not expect that the Fed will hammer down risk-taking for now. So there is little impetus for the rally to start to consolidate or reverse. Not at this point, at least. Looking at this bull-bear spread from investors' intelligence as well, it is breaking above the August 2022 peak, which suggests that investors are ready to embrace the rally. Last night, we saw S&P 500 breaking above the key resistance at 4,100. With 4,300 now being the next target. Nasdaq 100 is also above the key resistance at 12,167, which means that we could potentially see a rally to the next key level, which is at 12,740. Gold, that's also key to highlight. It reached fresh cycle highs above 1950. There's some resistance now at 1963, but beyond that, gold's path is clear until the big $2,000 level. So this current rally may have some room to run for now, unless data surprises. And that's really my key message here. In the short term, market sees no risk at all. But as the markets continue to ignore the Fed, there remains a possibility of a rude awakening down the road. And most likely, that will come from data first. It could be in either direction. Either inflation genie refuses to go back in the bottle, or perhaps economic data could start to weaken materially, and that hurts risk sentiment. So data is really the key to watch from here, and we have a host of that due ahead of the next Fed meeting on March 22. We have two sets of CPI, and worth noting also that CPI weights from January are being revised, so downside surprises could potentially become more prominent as well. But the most important currently is the labor market. Even the Tier 2 labor market indicators are now in focus, in addition to the usual non-farm payrolls. This week, we had weaker employment cost index that created some jitters as well. So keep that on your radars, along with the weekly jobless claims and JOLTS job openings and the likes. Critical to say, as you can see on this chart on the left here, the labor market is still tight. The ratio of job openings to unemployed persons has risen again to 1.9, but there are signs that wage pressures are softening. So labor market will potentially remain in the driving seat, And watch out for any risks to this Goldilocks scenario of soft landing that the market has priced in for now. That will be really big. But until then, enjoy the ride. That's all from me now. Stay tuned for more macro insights from us here at Saxo.